Good afternoon, everyone, and a warm welcome to all of you. We at Centrum GalaxC thank you for joining us in this webinar on opportunities in mid and small caps, a topic which we believe is highly relevant and of keen interest to the investors across the spectrum. To help us navigate the evolving landscape of mid and small cap investing and identify quality opportunities within this space, we are delighted to have with us one of the finest minds in the investment industry, Mr. Pranav Gokhale, Senior Fund Manager at Canara Robeco Mutual Fund. Pranav is a chartered accountant with close to 23 years of experience spanning equity research and fund management. He currently manages over 18,000 crore of equity assets at Canara Robeco Mutual Fund. Pranav, a very warm welcome to you, and it's a pleasure to have you with us today. In conversation with Pranav is Mr. Arun Gopalan, who heads the research and investment strategy at Centrum. With this, let us begin today's webinar. Over to you, Arun.
Thank you, Disha, for the very crisp and clear introduction. And first of all, let me welcome Pranav to this webinar. Thank you for taking time out. And I also welcome all the participants today. We are in the middle of in a day which is sandwiched by two holidays. So obviously, a lot of people will be looking forward to the weekend. But I do thank everyone, those who've joined so far, for taking the time out on this Friday afternoon to discuss with Pranav the prospects of mid and small cap companies in the Indian ecosystem. So I'll just run you through the course of the webinar. How we will structure it is initially I would rather have a very freewheeling chat with Pranav on various aspects of the economy, on various aspects of the markets, and then specifically on his forte, which is mid and small cap space. And once that is done, all the participants who have questions, you can raise your hand or you can put your question, drop your question in the Q&A box. And the last 15 minutes of this webinar, we will address your questions, at least try to address as much as we can. So Pranav, welcome to this webinar.
Good. So good evening and warm welcome to everyone. Thank you for having me on your show.
Yeah, Pranav, I know it's a very busy time for everyone, markets keeping everybody on their toes, and even people are having to watch the international goings on at this time to understand what might be the impact on Indian stocks. So obviously, a very busy schedule for all of you. Thank you for taking time out. So Pranav, given the fact that you've been in this industry for so long, and we have been keeping track of some of your funds, and your excellence in mid and small caps is quite known to everyone. And your fund has also been recommended by us at various points in time. And so we do have an idea of how you approach. But given the fact that, we have seen so much of volatility, so much of events happen at the macroeconomic and geopolitical side, I would like to begin this conversation with your view on the overall Indian markets. Where do you think India stands today? Before we get into mid and small caps, a quick outlook on, is India resilient enough to withstand the storm that is coming, in terms of the tariff struggle which we are going through, and the pressures to do with trade, the creation of new blocks. How do you read this whole thing, and where do you think India stands? Do we find any strength in all of this?
Sure. So India continues to be reasonably resilient, which can be seen that we are one of the fastest growing economies. So that is, very clear. One differential for us is in terms of our exports are largely services. So to that extent, there is a lot of domestic consumption which happens, which is slightly different versus others. So if you look at many other economies, it's either exports of commodities, it's either exports of manufacturing goods, and in many cases the own domestic consumption is not that much to take care of things. So when it comes to India, you have all the cylinders, if not firing in a big way, but at least working well. So that is where India stands a good chance versus the others. When it comes to tariff, obviously we will also have some kind of an impact. One major issue which we might see is because of the trade deficits. The trade deficits are expected to inch up, and also there is a technical angle because of which BOP situation might be a bit of a issue, which is already displayed in terms of how our currency has actually behaved. If you see where the rupee is today, but incrementally, it is also more to do with the flow than what the own parameters of the country is. Economically, we are very resilient. Our GDP is growing well. It is one of the strongest across the thing. Inflation is well managed. The balance sheet, both the corporate as well as the government, is in a very steady shape. Corporate balance sheet has been one of the best across the decades. Government, if I look at central government debt to GDP ratio, is also well managed. They are on the glide path. So to that extent, I think we are in a reasonable shape to take care of things. And as and when the tariff saga unfolds, probably we could end up being beneficiaries somewhere down the line.
Right. So when this whole thing started last year, we were wondering whether India would benefit from the China plus one, and whether the tariffs will be more on China, a bit lenient on India, and then this would sort of benefit our industry. But we have seen that quite a few of business has moved to other Southeast Asian countries like Vietnam, Laos, and even Bangladesh and Indonesia and all that. So given all of that. Do you feel that the tariff situation might work out to India's benefit, even if a resolution is found out? And if so, by when do you think this whole thing will play out during 2026?
See, it is anybody's guess, with this tariff situation. So honestly, nobody really knows unless the two people at the helm really sit and get things rolling. So, but honestly, it is not just about China plus one. Incrementally, it is one country versus others. In fact, it is China versus China also when it comes to certain aspects. So clearly, what it helps is try to get the manufacturing excellence, and probably it provides an opportunity for a country like ours to actually then take care of certain things, take care of the entire ecosystem, the manufacturing ecosystem, and then come out much stronger.
So that brings me to the question that you are running the manufacturing fund as well. So that's one of your fortes. Manufacturing is one of your fortes. Given that, how do you look at manufacturing? Because if you remember, I think about 2 years back, roughly 1.5 years back, when the correction began in September 2024, is when the market started falling. At that point in time, there was a slowdown in manufacturing, and there was a significant slowdown that happened in terms of manufacturing. Do you think we've come out of that phase, and where do you think manufacturing is headed in India over the next year or so? Do you think one should consider manufacturing as an area where one should be overweight at this point?
See, manufacturing as a theme continues to play well. It is something which is the need of the hour today. Because see, so far, if you look at what things have shaped up in terms of our country, there is a service component which is really done well for the country. But with the kind of people which are coming into mainstream jobs, who need jobs over the 5-10 years, there is a significant amount of population. You're broadly 10 to 15% of world's population which is going to come in the job stream. And service can only take care of only this much. Agri beyond a point cannot employ so many people. So manufacturing is today the need of the hour. So what we are doing in terms of manufacturing is there is an import substitution element, there is an export element as well. So manufacturing in India is going to be a dual kind of a story where there is some amount of import substitution which will happen. And based on how things pan out in terms of tariff situation and other things, is where the export component will also pan out. Of course, in any story which evolves, you keep on getting these bumps. And what we've seen recently is also one of it. Partly to do with is the market kind of overplayed the theme, and because of which valuation in case of certain cases kind of inched up. But when you look at profitability of many of these companies, they continue to be strong. They continue to deliver in terms of profitability. So while market price in terms of barometer has definitely worked against these manufacturing companies, but if you look at in terms of the profitability growth, it continues to remain strong, which is where, when things actually fall off in terms of valuation or they become conducive, that is the time when you should actually add towards the theme. And when it comes to India, the manufacturing is not just pertaining to one small sector. It encompasses lot many sectors. So the theme to that extent is a much larger scheme. There are lot many different companies across market capitalization, across industries, which end up being beneficiaries of it. What we saw, EMS was just one leg of it. In terms of others also, when it comes to automobiles, it comes of auto ancillaries, when it comes to even, the secondary goods or even capital equipments, we'll continue to see good amount of growth. So there are companies who have put in capex, and companies, as I said, the balance sheet, the corporate balance sheet is in a very healthy state. So somewhere down the line, you will continue to see a much larger profitability, potential over a period for many of these entities. Which is where, to answer your question, yes, there has been a valuation correction in many of these companies where the valuation had gone overboard, but companies continue to be resilient. Companies continue to report decent amount of profitability, and some of these downticks should be looked into investing in the theme. And for any theme to actually play out, it is more of a 7-10 year phenomenon. Manufacturing is not going to happen overnight that we're going to suppress this, we're going to suppress that. So basically, just stay in the theme, give yourself a lot more longevity, and you will see you make decent returns.
Perfect. So typically what you're suggesting is it should be a long-term bet. Manufacturing is something which investors should be holding for around 5 to 7 years. Is that what it should be like?
That's a minimum thing.
Okay. So the other thing which I wanted to find out from you, Pranav, to pick your brains on this is the small cap space, the mid and small cap space. If you see 3 years ago, 4 years ago, the performance was fairly competitive when you compare it with the large cap space. The mid and small caps are doing very well. But if you look at the performance last year, it has been a washout in most cases in the mid and small cap space. So do you see an opportunity there, or should investors be wary of it right now? And do you see 2026 playing out as basically another large cap year, or where do you think one should position themselves in the market cap spectrum at this point?
See, to answer this, I'm going to take you back a few more years, which will give you a context to what I'm trying to tell you. If I look at the earning profile for Nifty 500 companies, it did not go anywhere between 2015 to 20, be it BFSI, non-BFSI leg. What happened is, it used to be in terms of trillion rupees, about 4.3 trillion going to 5 trillion from 2015 to 20. From 2020, which was about 5 trillion odd, the earnings in 25 has gone to 15 trillion. So it's 3x the earnings in 5 years. That is how fast we've grown. Because of which many times the valuation actually inched up for the entire market, because you were growing at that fast speed. And when you actually triple your earnings in matter of 5 years, one does end up taking a bit of a breather because the base starts picking up or catching up. Even the current year, you will see broadly about 10-12% kind of an earning growth for the industry as a whole. When I'm talking about this, I'm talking about Nifty 500 as a whole. So the point I'm trying to make is, it was earning led, it was not just valuation led. But when you're paying top dollar for that kind of a growth, and the growth subsides a bit, automatically there is a correction in the offering, which led to this correction over the last, in fact, 2 years. Now the large cap have actually been able to outperform the mid and small caps. But this is a time when you start incrementally allocating to mid and small cap, because that outperformance which we had seen over the last 3-4 years from say 20 to 23 has kind of ebbed away a bit. So what has happened? As I said, earnings continue to be really good, but valuations have corrected. So they have become much more palatable today. Are they trading cheap? The answer is no. You're still trading about 15-20% premium to the long-term averages. But today you have a much better, healthier balance sheet, and earnings are going to help. So in terms of earning trajectory, probably if you see mid caps have done better than small cap because earnings have been much more resilient. Now the same base is going to catch up in some of the mid caps. And when it comes to small caps, that low base will actually help deliver or look, the earnings will optically then even look much better. So answer your question, in fact, this kind of underperformance versus the large caps has kind of played out a bit. It may go on for next 3-6 months, but within this period, those downticks or those valuations should actually be used to invest further in mid and small cap if one has a 3-4 year outlook at least. Reason is valuation today is still not cheap. So you're going to look at a high earning growth, and for that you're paying a bit of a premium. Having said that, the period of from 2023 was all about beta, where every and many of them were actually delivering superlative earning growth. Incrementally within mid and small caps as well, it will be a story of alpha where they will actually have to differentiate one company over the other in terms of its ability to generate much larger profits over a period.
That's fair enough. Very good. So we understand that clearly now that this space is something which we have to watch out for right now for the next 3 years. But in terms of an engine of growth, if you look at it, India largely still is driven by the large caps. But increasingly, if you look at the IPOs that are coming in, the new companies that are getting listed, so the small cap space is getting populated more and more in terms of investable opportunities that we have. We've seen so many IPOs that have come in the recent past, good manufacturing enterprises which have come in and got a good valuation. And I think some of the fund managers also invested in it. If you see the anchor investing list is growing larger and longer in almost all the small caps which are coming. So given that, I think there's a lot of interest that is coming into the small cap space. And there's a lot of investor money which is also coming into the small cap area. If you look at the last 2 years, the number of IPOs have been going through the roof, and it might continue. We don't know what the trend in 2026 will be like, but it seems the small cap space is really ballooning quite a lot in terms of participation, right? And within that, when you look at many of these companies, either as an investor or as a fund manager, selecting the bets becomes a bit of a challenge. Either you start investing in every company that's coming, or it's a challenge to cherry pick companies from among such a flurry of IPOs that come. You can't make out which are the bad eggs. I mean, at least for the common investor. How does Pranav Oakley do it? How do you look at these companies when so many new companies are coming, getting listed? How do you select among all of these?
Okay.
Including
so as a fund house, we follow something known as business, management, and valuation, the three parameters. And all these three go in terms of conjugation to select a company. So I'll take a easier aspect, not so easier, but easier to explain, is the management. So you take care of companies who are actually allocating the capital well. There is a reasonable amount of standard when it comes to corporate governance. And that is how you, because that becomes a paramount. In many of these mid and small cap investing, it is like you end up marrying them. So you might as well be very sure and very choosy whom you want to, be in association with. So that management aspect comes into it. Valuation, we'll take it up later. It's the business which I want to sort of highlight. So when we look at these mid and small cap companies, they are mid and small cap because of the market cap. Essentially, they could be MNCs or they could be very niche sunrise industries or sunrise companies as well. So what we tend to do when it comes to business as such is look at the quality of the business, look at the tailwind which is surrounding the business, and look at it from the strength of the balance sheet. So what do I mean by the quality of the business? It is in terms of the moats which they have, the pricing power, the sustainability of the revenue, the ability to keep on increasing or growing the revenue. When it comes to the economics surrounding it, and that is where the business tailwinds comes in. Whether it is backed by certain policy aspect of it, or is it backed by certain geopolitical aspect of it, and or is that something like a supply chain shift, which we've endured between 20 to 23. The reason is that becomes very paramount as to what is actually going to drive the business apart from a reasonable management. Then you go to the financial aspect of it, which is more to do with the resilience of the balance sheet, the ability of the business to generate free cash flow, a decent amount of ROC. And in while doing so, the thing which I mostly rely on is take care of the unit economics. What is unit economics? Try to unitize how the business is being done. The ability for a particular company to self fund itself, or the unit to self fund itself, because it will become a sum of the part. To let me explain it in this way. Suppose you're looking at one company which is putting a store, and the capex per store is say 100 rupees, but it can generate 5x sales, and that sales actually is something which will be able to actually garner and generate EBITDA. So if say on 100 rupees investment, if the one particular store is generating, let's assume based on the asset turn and margin, let's assume 20-25 rupees, it's a healthy ROC. So even if you keep on growing, this one store will become two stores, will become four stores. It becomes the ability at a given point of time, those cash flows from 5 store, 10 store will be able to sustain and help you get into own funded stores. So that unit economics matter. So how we tend to approach it? Business, management, valuation. Now, valuation is something which I want to talk about. When we talk about valuation in general, what we say is, are we just paying for the narrative, or is there something in the essence for the companies which we are investing in? Sometimes the narrative becomes so loud that you end up overpaying for the companies, and many a times, even if you like the businesses, you tend to then cut down on the position sizing. So this is how we tend to approach in brief in many of these companies.
Okay, great. So that's a fairly structured approach to picking these companies. Now, when we look at small caps, the failure rate is also very high in terms of the number of companies which don't perform, right? The volatility in terms of performance and non-performers, that's also very large. You sometimes get good companies which we believe will do well, but somehow, a little inflection point they pass through, and a little bit of volatility in terms of either order books not playing out or in terms of some execution not happening, and then they take a hit. So when a fund manager like yourself creates a portfolio of small cap companies, what sort of failure rate would be an acceptable failure rate? What do you think will be, if you have a setup? Because I have seen in the last 3-4 years the ballooning of number of companies in a small cap portfolio. Maybe because of market cap itself moving up, the cutoff for market cap moves up. So the number of companies that are part of your small cap portfolio crosses 3 digits. And I have seen a particular fund house where they have 180 companies in small cap space. So the question is, how do you manage such a large portfolio of companies, and how is yours any different from that? Or do you think this is the way one should build a small cap portfolio? How does a portfolio construct work?
See, what happens is, in case of very large fund, the position sizing and becomes an important aspect to it. What happens is, after a beyond the point, because some of the funds have become so large, in many spaces, even if you end up buying 1-2% of the position, you end up buying 4-5% of the company. So in many cases, you also have to consider the free float and the volumes aspect to take care of the things. If that is something which is also considered in terms of the risk parameters, many a times what it ends up is, many people then end up buying more and more companies, because you can only buy only up to a certain percentage of a company. Like I said earlier, it is effectively you end up marrying many of these. So then, as the flow starts, what you do is you tend to then diversify. Having said that, there is also this ability, because see, I'll give you an example. In 2019, when we started small cap, the top number, the 251st, as it used to start, was about 8,000 crores. Current, it's about 34,000 crores. So what has happened is, the number of companies, have really gone up significantly. You get numerous businesses which you otherwise would not have been able to invest in, which you are able to invest. And many a times, what it may happen is that you move around with the position sizing, but you still want to invest in a business. So, which is where many a times which people tend to actually have larger. One is to do with the size, the other is to do with the liquidity parameters of it. So that leads to many times these stocks being more of 90, 100, in some cases much higher than that. But that is how you can't do much about it beyond the point. To be honest, having said that, because you're considering liquidity, you're also considering that in case of mishaps, at least you'll be in a position to sell some of it.
Correct. Agreed. Yeah, so that's an unavoidable. These portfolios will tend to have a lot of plays within it. So, Pranav, coming to the other part of what I wanted to talk to you about is primarily what sectors do you think would the small cap space look to, what your small cap fund look to invest in the next 1 year? Is there any shift in terms of sectoral allocation? Do you think we should be moving out of some sectors into some sectors? Where do you think 2026 will take us in far as the sectoral bit of small cap funds is concerned?
See, the way I tend to, the way we tend to look at the small cap portfolio is try to have more growth centric kind of mandates. So tend to invest more and have more allocation to where the growth is. So if you look at how the what areas we are positive as, so basically it is to do with the entire manufacturing and allied space. When I talk about manufacturing and allied space, we did discuss in detail. It's also about the capital good companies. It's also about automobile, auto ancillaries kind of names. The EMS space as well, where you are comfortable with the balance sheet and ROCs and their ability to then generate cash flows going ahead. The financialization of saving, now that is one of the most important things which has played out over the last 3-4 years, will continue. So it is not just about banks and lenders or NBFCs. It is also about these participants, be it wealth management, asset management entities, be it the insurance brokers, in terms of the other ancillary plays to the capital market, in terms of the register and transfer agents and the exchanges. So that is one theme which we are still positive on. The other is, where India's consumption is actually either at a very premium end or at the low end. So we tend to look at these modern businesses which tend to take care of either the premiumization of whether it's branded apparel, or when it comes to automobiles, or whether it comes to, even for that matter, more to do with jewelry for that. So that is where we are, where the consumption is still holding up. Uh, Travel is again a theme where we are positive on the hotels, the travel overall, the luggage space is which continues to still do well. What COVID has taught us that travel is also an essential thing. So a lot of people continue to travel, and which is where so we thought that is one theme which we remain positive on. The other portion of it is the technology ER&D space and the SaaS space. It is not the old legacy service space, but more to do with the ER&D SaaS module, or the guys who enable many of these entities to function or deliver or do business, including the logistic aspect of it. And that is where we are positive. So these are the themes where we are actually positive on. This is where we have invested. This is where we see a growth sustaining for a much longer period.
Great. So the EMS space last year was in focus, where we saw, companies come in with, huge valuation. Fund managers continue to invest in them, and the prices went sky high. And at that point in time, we did feel that things are looking good for these companies. There was enough of government push for these companies as well. They had a lot of tailwinds coming in from industry. They had a lot of tailwinds coming in from the ministry. A lot of things, everything seemed to be, working like it was like absolutely Goldilocks moment for all of these companies, until we don't know what went wrong. But that's where you need to come in, Pranav. What went wrong with EMS, and why is it cracking the way it's cracking? And where do you think we should draw confidence to remain invested in this space? Or do you think it's a great opportunity for people to get in at this time?
See, when you look at EMS space again, it was also about government policy decisions and the change in supply chain, if I have to use the words. Now, because of the geopolitical scenario, the way it plays out, and it remains very fluid. what happens is, in many cases, what could have happened in terms of growth did not pan out. In many cases, when it comes to government policy decision, again, there were certain aspects where companies thought it will happen much quicker, but did not play out. So that were the two aspects which are external to it. The internal to it was also, because they had, in many companies, they had to come to a valuation which they were, certain projections were given, and many companies did not end up meeting those projections. So when you are paying high growth multiple and a very high PE, what happens is, even if there is a PE derating incrementally, despite companies delivering on profitability, because your entry multiples are so high, you still end up, drawing from your capital if you invest in some of these names, and that is probably what played out in a few of these companies. Second, they actually went a bit overboard when it came to their own capex. So, as I said, one of the aspect is the ability to generate free cash flows. Now, in many cases, because they could get some approvals in place, a few companies actually have gone a bit overboard when it comes to capex. And if that capex actually doesn't end up playing out in terms of delivering those asset turns, probably it will be a very ROC dilutive. The incremental ROCs could be a very small number, in some cases, even a negative number. And if the existing business is doing well, but the incremental ROC is going down, this is what led to some of these EMS stocks actually, a few of them actually not doing the way they are. So starting entry multiples, the high growth which actually tapered off, and some of the things related to the government policy. So these are the three key things. Now, to answer your question, in some cases it will provide opportunities because the space has really corrected, and if they continue to deliver on growth at certain valuations, these start looking attractive.
Would that be the right time? This would be the right time for
Yes.
that?
I'm not sure if this is the right time, but I'll kind of wait up for the earnings to pan out, because now
Okay.
it's the question of how the earnings will pan out. And when I say earnings, it is not just the profitability; it's the operating cash flows also which matter,
Right.
because you
Exactly.
have to deploy them to generate further capital. If they are not going to be there, it becomes difficult for you to invest, for which these companies were paid for.
Right. So would you advise investors to wait a while before they allocate to small caps until the earnings season plays out?
No, I
That's
was
what
talking about the EMS piece. This was about the
only about
EMS
the
piece.
EMS space. So as far as
EMS
EMS
piece is what
companies
they
which
are.
have corrected, I think people should
Yes,
wait a while.
you have to be selective. Where there is a operating cash flows which take care of the future growth, then some of those companies one can start investing. But it is always prudence is better at this juncture.
So what about two spaces which I was very keen on finding out from you, Pranav? Do we have any opportunities there? The first one are the smaller financial services entities, the NBFCs. Uh, what do you think is the situation there? You do have an exposure to that space. So do you think that's something one should start looking at now? Is the pain over in that area?
See, I'm looking at some of these companies like turnarounds. So in fact, we did buy into them when things were not so great. Today, what has also happened is that space was also crowded, and what happened over the last year and a half also led to things where the competition has kind of ebbed out a bit. So, which gives the ability for guys in some cases to become or emerge stronger, uh, because they have probably managed the situation a bit better than a few other guys, and probably now they have money or the capital to go and grow further. So, which is where we do believe that some of these niche NBFC plays could actually be something to look out for. And because of the way the interest rates have actually moved down, probably it gives them a bit of a benefit when it comes to the cost of funds.
What about spaces like auto ancillaries, where again you have a sizable exposure? I think 5 or 6% of your portfolio, I guess, is in that space.
Yeah. So many of these companies are actually bottom-up picks. It is more to do with how the auto is one space. If you see in India, we continue to do well. I mean, post the GST reforms as well as even now, And many of these auto, so one option you have is buy into auto OEMs, and you have to pick winners, or you look for companies which actually supply to many of them, and you don't really have to then necessarily pick a winner, but look for guys who actually benefit either if one or the other does well. And apart from that is the export angle to it, and many companies which actually now will have that ability to go and even export. And it is not just about US, it is exports to other destinations and other high cost destinations which have now over the last many years accepted India as a decent manufacturing destination. So which is where the auto ancillary component comes in.
So Pranav, given this mix of sectors, mix of players that we have in your fund, and it's a very diversified approach. I was reading somewhere, uh, is it diversification or is it diversification? I think it was somewhere in the ET article or something a day or two back. So, is there a limit to which an investor should diversify his portfolio, or what do you think is the ideal? If I'm creating a small cap portfolio, a component of my portfolio, a small cap portfolio for an investor, of course, the primary go-to will be go to a mutual fund which is doing well and allocate your money to that fund, and don't try to break your head over investing in individual stocks yourself as an investor. That would be the right thing to do. But of course, we do have a lot of investors who have their own, funds which they would like to dabble with a little bit. In which case, what do you think would be the ideal number of small cap companies to hold in a portfolio of maybe say 3 or 4 crores? If someone has a 4 crore worth of portfolio, what do you think should be the small cap component over there?
See, what I've learned a bit from stalwarts, and believe me, I manage public money, so I am not an expert to talk on this. So that is my first disclaimer. But it is always better to invest in companies you understand rather than have a over diversification, if I have to use the term. So that I don't want to come to an ideal number because I really don't know what an ideal number is. Rather than that, stick to the conviction, stick to companies or businesses which you understand, and then take sizable portion or bets on those businesses. I think that is a kind of a better outcome, because for an individual who wants to generate wealth or who wants to generate much superlative, alpha, I think a diversified strategy may not play out. There is a risk associated to being concentrated, but if the end outcome is to generate wealth, then I think sticking to a few names, and I'm not gonna restrict myself to a number here because that's not my forte. It is better to have ownership in a very few concentrated bets which you understand the business.
And staying on it, and staying invested.
Yeah, and stay investing on it,
That's the
and
secret sauce.
understand the guiding post as to why you invested. Is it more to do with a macro? Is it more to do with the company's own bottom up thing, or is it more to do with a structural change? And then based on that, the selling discipline actually is important. Otherwise, if the story is playing out just because certain becomes a tad expensive, I think there's no point in churning the portfolio a lot.
So any number you want to put on the returns one can expect in the small cap space this year after last year's disappointment? Where do you see large, mid, and what's your view on the earnings bit? What do you think
hazard a guess? But all I can say is, if you look at the earning growth profile, and this is for companies at large, is expected to hover around 12-13%. So if I take a 5-year view and I expect earning, or a 6-year view and I expect earning growth to be 12-13%, you're going to effectively double it over 5-6 years, the earnings growth. And today you're trading at a 20% premium. So ultimately, rather than giving a year's view, which you asked, because really we don't understand, what is actually going to happen, to be honest. So it's better that over the period, what will happen is, if the earning compounding is going to be 12%, 13% odd, in 5-6 years, you're going to double the earnings. Your returns could be 70-80% plus over 5 years, not a CAGR, but absolute basis. Because today your entry multiple is 20% premium. So that is what you should bear in mind. And again, small caps is not a game for 3 months, 6 months. It is for the larger. So I've given you a 5-year view. which is probably what is required because that is how the cycle plays out.
Excellent. So, Pranav, that was a very crisp, insight into how one should approach the mid and small cap space. So, if I might just summarize what you've just said for the benefit of the participants on this webinar. It's a short webinar, but it was very useful. So, if I might just summarize what Pranav said, India stands in a resilient situation right now. We are capable of weathering the storm that's being unleashed by tariffs. There will be hiccups along the way, but one has to play this theme out over a long term. Mid and small caps is a place where one has to stay invested. So tenacity is very important. So temperament in terms of approaching the space is also important. There will be volatility. One has to stay invested for a 3 to 5 year period. Manufacturing, which is one of the important subcomponents of the mid and small cap space, there again one has to stay invested for a slightly longer period, where Pranav has said advises investors to stay invested for 5 years and longer. So you have to stretch the timelines a little to get the full benefit of the earnings that these companies will be generating over a period of time. And what Pranav says, how you should approach that space: stay concentrated in your breads. If you are going to play the markets directly, if you are going to play it via a mutual fund, nothing like it, which is what we would recommend all our investors to do. Leave it to experts like Pranav to handle for you. But if you want to play that space, stick to companies which you understand, stick to enterprises and businesses which you understand, and play a concentrated play on that. Don't diversify too much into companies where your knowledge is a little thin. Try to keep a concentrated bet and stay at it. So that's the takeaway that I have, from Pranav on this webinar. And I see that a few questions have also, been put on the Q&A panel over here, and I'll just take a few of them. Someone is asking, one of our RMs is asking, can an investor do lump sum investing in small cap fund, or does he do it in a staggered manner? So what do you think is the preferred method of investing in a small cap fund? Is it going to be, would it be better to put in lump sum, or stagger it over a period of time, even if you have the liquidity?
See, I probably use a term quite often. Be fearful when others are greedy. Be greedy when others are fearful. Why I say this is normally a SIP or a staggered basis discipline investing works in a small cap, but there will be times in small cap when actually there is a lot of correction in the offing, even during the year or between a block of 2 3 years, and that is a time when valuations are in your favor. You need to put in a significant amount of money, because the entry multiples are in your favor, because any small caps are likely to have a superlative earning growth versus the larger market. So when earnings are in your favor, that is when you make a much better alpha versus what would normally be. So to put it in a very one line kind of a answer, stay invested in a very staggered simplistic manner, and when valuations are in your comfort zone, that is when you start putting the lump sum.
Excellent. That's a very good answer, because that gives a lot of flexibility to one's portfolio, where you are following a disciplined investing methodology via a SIP, but you're also keeping some powder dry to pump in the money when there is a steep fall in valuations and you see some opportunity coming in. Am I right? Am I interpreting that
Yes,
correctly, Pranav?
absolutely.
Okay. So I hope that answers that question. I have another interesting question here. I guess you already attended to that, but again, risking reputation, I will ask you that. When do you anticipate a meaningful recovery in small and mid-cap segments, which have already declined significantly in the recent months? So I guess what he wants to ask is, do you see a further fall from here on? Or do you feel that, the markets are good enough for us to start investing? Should we start deploying money into these small caps at this point?
See, small cap, from an earning perspective, small caps have already endured a pain over the last 6 9 months, 1 year plus. The base is in their favor. Now is a time when actually the earnings will start looking a much better. Valuations have corrected, and still they are much more palatable than what they were, 18 20 months back, which is why it gives you an opportunity to start investing in some of these names. Is it bargain basement cheap? The answer is no. But that is when you use the lump sum aspect of it. But incrementally, you are looking towards now where earning growth profile is expected to improve, and that is where you start investing in some of these names.
Okay, great. So selectively, one should start participating. Are we at the end of the tether on the downside? No, we are not. There is still some more downside possibility here, but one should start taking this opportunity to pump in money, invest in this. So that's what you intend, Pranav. Am I right on that?
Absolutely.
And someone's making a comment here, which I do believe is an important question here, is that, this is something which has been plaguing the small cap space for years now that I've been seeing, is that the question here is, your small cap fund maintains a true small cap focus, investing in relatively smaller companies. Do you see rising AUM become a constraint at some point? At what AUM level would you start feeling uncomfortable managing liquidity? And till what level will you stay true to your strategy?
Okay. So I hope I endure that problem soon to start off with. But yeah, to answer it in this way, let me break it down in terms of what these small caps are about. If I tend to look at some of the small cap aspect of it, today, as I said, the top name is about 34,000 crores. The bottom name is about 8,000 crores. If I average it out today, across that 250 names, then the number is closer to about 20,000 crores of average. So you have basically 250 companies into 20,000 crores market cap, or to put it differently, you have 250 companies, if I assume 50% free float, into 10,000 crore market cap. So then, even if I have to invest 1% in a company, a 25,000 crore number could be easily done with out of the free float. I'm not saying out of the total outstanding capital. So that is the size when I think really the liquidity should remain a challenge. But how do you tend to do it? Is you diversify it, and then you then have the portfolio sizing based on how things is. The other aspect of it is not necessary you invest 100% fully in small caps. You have the leeway whereby which many of your small caps, in fact, will be companies which you invest as small cap and become large caps of tomorrow. So that is what you are actually looking forward to. So at any given point of time, you will have 20-25% of your portfolio which are mid cap or large caps. Some because you want to be present there, and sometimes also because these are small caps which have become mid or large, and you still want to own the names.
Right. Very good answer there, Pranav. I hope that answers your question. Another question I have here, interesting one again. How do you sell the company that you've bought? What do you think would be the triggers that you would be looking at to cash out of a company? How do you sell the company that you bought, basis price or fundamental factors? What do you look at when you take a call on exit?
Thank you for this question. Actually, I should have answered this. Yeah, so this is a very important. Selling discipline is one of the key. So I just alluded to when the narrative becomes excess than what the numbers will. That is one, you do it. Second, you need it in terms of liquidity, or you find something much better than which it is. And one aspect, the other aspect is when the investment argument doesn't play. So today, for example, if I have to invest in, say, an EMS companies, and I believe that the operating cash flows are something which are going to sustain, and the company will generate these and invest, and I see the company growing in terms of revenue, showing those profits, but sacrificing their operating cash flow. Now that becomes a time where it's a warning signal, and since the investment argument will not play out the reason why I bought it, that also becomes the reason to sell. So the aspect is you need to be clear on the investment hypothesis. If that is not playing out, that becomes a reason to sell. Cash, liquidity, or better alternate investment. So these are the reasons. And the other aspect is capital misallocation or corporate governance issues. That's a strict no-no, and we manage public money, and we are very careful when it comes to this thing. And that is when you sometimes tend to exit stocks.
Excellent. So this was a question I did want to ask earlier, as selling actually is 50% of the job. Buying is only the beginning, but it's the exit that actually determines how much money you actually make for your investor. So that is a very critical decision, and I hope Pranav has adequately answered that. So there are several more questions over here, but we just running short of time a little, and I wanted to ask you a couple of things from my end. If I ask Pranav Gokhale for two gems of wisdom which investors should keep in their mind, what are those two things which investors should bear in their mind when they touch the small cap space? What is that in terms of discipline, in terms of inherent qualities they should develop? Because not everybody has the temperament for investing in that space. What is it that an investor should cultivate from within that will give him that edge in small cap investing?
I've used this before. I'm going to repeat it again. Be greedy when others are fearful. Be fearful when others are greedy. That is one thing, which matters. Second, be valuation conscious because entry multiples matter in many of these small caps. Uh, you know, Significant alpha is made when you enter this space at the right valuation. So when people talk about time, valuation is something which you need to give due cognizance to. And third thing is, stay invested. Many times more you end up losing more returns than waiting for a time than actually, so you miss out on a lot of returns just waiting. So it's always better you start allocating at least some capital out of what you have, rather than just sitting for a sidelines and waiting for a bad day. Because sometimes valuation overstates for a significant period and you end up losing that kind of return as well.
So, two things: be conscious of the value, and be greedy when others are fearful, and be fearful when others are greedy. So, two dictums which all investors should follow when they're touching the space. So, thank you so much, Pranav, for the very brilliant insights that you've given to us. And I'm sure all the participants here would have truly benefited from this discussion that we had. And thanks to Brian for having coordinated this for us. And Pranav, we will have you back on our webinar very soon. This is just the first one we're having, the first discussion. We will discuss more on the mid and small cap space as the year plays out. So I hope to see you soon.
Thank you
back
for
with
having
us
me.
On air.
Thank you, and a happy weekend to everyone, and happy investing.
Yeah,
Thank you.
Thank you for participating. And over to Disha for closing remarks.
Thank you, Pranav, for taking time out of your busy schedule and sharing your valuable insights with us today. And thank you to all our participants who took the time to join us for this webinar. We truly hope you found the session useful. With this, we conclude today's webinar. We look forward to having you with us again in our next webinar, where we will be joined by yet another industry expert. Thank you, everyone, and have a great rest of the day.
Thank you.